In our Alpha Managers segment today, we have Mahesh Patil, Co-Chief Investment Officer at Birla Sun Life AMC. Mahesh has a life of rich experience, in this financial services business. Good afternoon. Thank you for joining us on Closing Bell, Mahesh.
Thank you.
I'm going to start by asking you what you make of where we are in the markets. 8,800 come and gone, 8,900 within touching distance today. Are we running up too fast, do you think?
Yeah, I think, after this month has been a pretty stellar month where we had a lot of positive news coming in. We had a rate cut and also a stimulus in Europe. So I think that liquidity is what...
But both were known about. It isn't that both came as an absolute surprise.
Sure,
Maybe the timing on the rate cut front was a bit of a surprise, but we knew that we were moving towards a down cycle in rates. We knew that the ECB... sovereign bond buying has been discussed for the last 5 months with regards to the ECB now.
Right.
So would you say that these are not necessarily factors that justify the move up?
No, I wouldn't say that, but I think we've seen liquidity has been pretty strong, okay? That global liquidity, there was some concern in the latter part of in month of December where we saw some outflows. I think more importantly, I think the domestic liquidity into the equity markets has been pretty steady. So we have seen almost like 55,000 crores of monthly inflows into the equity market, into mutual fund industry. And that's actually providing a good support for the market. And I think more important, I think no one is willing to give it because I think the longer term picture, at least for India, looks pretty good. And even globally, I think if you look at India, looks the only economy which probably will grow, a large economy where the outlook like to improve in the next 2-3 years. So I think no one is going to pull the plug soon. And so I think the corrections also in this market won't be very large. And as earnings outlook changes, I think this quarter might still be a bit subdued in terms of earnings. But I think next year, I think things are looking, I think we should...
You mean FY16?
FY16, yeah, I think with rate cuts and some operating leverage kicking in, some of the companies' demand picking up, say in the consumer side, we should add some impact of the lower commodity prices. I think that should benefit. So you should be expecting around 17-18% earnings growth next year. Yeah.
Okay, Mahesh, then taking that into account that you're expecting 17-18% growth, we're not trading at 17 times or 18 times or 15 times. Currently, we're around that 18-19 times odd. When exactly do we become quite expensive?
So I think currently, if I'm not mistaken, we on a 1 year rolling forward, we would be around 8% higher than the long-term average, okay, which is around 15.5. And so we are in a scenario where outlook in earnings growth in the next 3 years would be better than what we had seen in the last 7 years, which has been in single digits. Right? We are getting in a scenario where rate cuts, would be there. You could see another 75 basis point kind of rate cut. So your cost of equity capital will go down. So that can justify even a higher valuation.
Okay.
And most importantly, liquidity conditions domestically, as I mentioned earlier, would also improve. We expect domestic money moving into equities will only increase because the ownership level is still very, very low. So given these factors, I think potential for re-rating, if earnings indeed comes in growth at around 17-18%, not for next year, but even for the next 2-3 years, then even valuation re-rating from these levels can't be ruled out because we've seen what happens when liquidity comes in. So I wouldn't really bet on valuations. I would really look at earnings growth, whether they come in line with expectation. If that happens, then I think markets should do fairly well even from these levels.
Okay, and as you pointed out, many market experts have been talking of a largish correction which has not yet happened in this marketplace, and you're saying that one should no longer expect it given the kind of momentum we've seen, both in terms of the buying, the liquidity, all of that.
No, I'm not saying that. I'm saying corrections would come in the market. I think you can't have a market which will...
But they've been of the 5% variety, not necessarily the big, large corrections.
Yes, I think anything between 5 to 10% is something which I think one should be prepared. Investors should not be too worried about those corrections because we have seen that earlier also in the biggest bull run we saw 2003 to 2008. Markets corrected by more than 10% for more than 15 instances when the market did that kind of a correction. I think that's something which is in line. But the broader trend, I think, should be good. And a lot of investors would look to buy into the correction. And unfortunately, we haven't seen much supply of paper coming in. So that liquidity has in a market which is already where the depth is not that great.
Sure.
We've seen prices move up probably much more than one would have anticipated as a rational manager. I think difficult to find value in this point in time. Yeah.
Okay, and yet you've launched a new fund called the Manufacturing Fund. It seems to be an area you're taking a big bet on, but it's also an area that will likely show results only in 2 or 3 years from now, or maybe 4, if new projects is what you're betting on, in terms of portfolio allocation in that fund. Talk us through where you intend to, invest that money and what looks most promising to you in this manufacturing story.
Yeah, so on the manufacturing side, I think the key theme is that we believe that India, in terms of competitiveness, I think we have seen, especially against China, I think because of the labor wage inflation in China, also because of the currency appreciation in China vis-a-vis the rupee, India's competitiveness has increased. We have the resources, okay, in terms of labor. I think India contributes almost 25% to the labor force annually. And now with the top-down focus by the government also to really revive the sector, I think it's time that the sector should do well over the next many years. And India's manufacturing share to GDP has stagnated around 15% for many years, for a decade or so. If you look at a large economy like China, manufacturing is around 35% of GDP. I think we have a vision, at least top-down, to take it up to 25% in the next 10 years. Even if you go midway, I think you'll see the sector growing fast. But I think in the interim, what we are betting is that as demand picks up, okay, India itself is a large domestic market, and where consumption and demographics would still increase. So capacity utilization in the existing sectors, whether be it auto, okay, be it capital goods sector, or any of the manufacturing, that itself will drive growth in the next few years. And I think greenfield capex would take some time. I think the government is trying to do reforms, trying to address issues on land acquisition, labor reforms, which might take time. But I think despite that, I think we have seen success in sectors like automobile, in pharma.
You're convinced by the turnaround in auto?
Yeah, I think so. I think initially what we thought after the election results was more the pent-up demand, okay, where we saw volumes kicking up.
Now we've seen the excise duty benefit go away as well.
So now you might see a bit kind of a moderation in growth, I think. But as the consumer confidence, even rate cuts, so you'll see better money at the hand of the consumer. So I think you should see next year at least growth.
What do you like the most in auto?
So in auto, we like the four-wheelers. Okay, and in two-wheelers also, I think we've seen, but there's a competitive intensity is slightly much more fierce over there. And I think auto ancillary is a space where I think things are looking much better, because it's not a domestic market also, but a lot of Indian companies have been able to cater to the global demand and scale up pretty well over there.
Would commercial vehicles be part of your bet on both a revival in manufacturing within commercial vehicles itself and a revival in manufacturing in other areas that might lead to a pickup in freight?
Yeah, so I think that's another sector which we have seen. Commercial vehicles haven't really, we have not seen any meaningful pickup in volumes over there.
But so you're not so upbeat on commercial vehicles?
No, but I think this is the time to really look at it, right? So I think if you look at it in India, there are not many stocks. I think the leading player, okay, which is a domestic as well as a global player. So one has to take a view also on the global front, really, how we are positioned. But I think we should see a revival in the commercial vehicles also, because cut in fuel prices would also increase the profitability.
That would make, and I know you're hesitant to talk about specific stocks, but that would make Tata Motors and Maruti amongst your top picks when you look at allocating, let's say money from this manufacturing NFO or manufacturing fund NFO, at least in the initial months. Would that be fair?
It depends again on that point in time what the valuations are, but I think across auto space, I think whether it is four-wheelers, cars, or commercial vehicles or two-wheelers, I think all should do fairly well. And especially companies, I think we like companies which have strong domestic market share, but also have ability to really cater to the global market, because that's where the scale and size, okay, can really grow much faster.
Mahesh, talking about the auto space and Tata Motors, in fact, that's one of the cheapest stocks that we have in the Nifty space. The only one that trades, I think, sub 10 times. With regard to that, will you be playing that particular counter because, in fact, it's a global play, or are you expecting to turn it out? Not stock specific, but with regard to exposure.
Well, I think one has to look at what are the key drivers for any stock which you invest into, what are the key drivers for the growth. So I think domestically we would expect a cyclical recovery to kick in. Okay, we are at the bottom of the cycle, and that's where I think the surprise delta change would come in. On the global side, it depends in terms of the specific markets, okay, where you are and what is the, I think in auto it's important to understand the new launches. Right. So any new product launch can really add significantly to the volume growth in the near term. I think that's what is key. And that will really drive our investment decision, whether it is in four-wheelers or whether it's in the commercial vehicles.
All right, then looking at the cement space, it's a proxy to the infra play, I believe. And in fact, if you just look at prices over the last year, Rod, you've been seeing every time there's an increase in prices, demand's not really following up on that front. And even earlier this month, if you see prices have been increased, and now there is a tendency to start pulling prices back. What's going on there? What's your exposure with regard to the cement space? Do you think there's more to go?
So cement is a direct play on the domestic infrastructure play. So there I think we have seen demand from the housing sector being pretty strong. On the infra space, we haven't still see any meaningful pickup over there. But our sense is that we'll see now kickoff on the roads. Okay, already there's bidding for 40,000 crores worth of road projects. Okay, which tendering would happen, and you should see work on that progressing. Even in other infra areas like the urban transportation or metro projects, they are going on pretty well. So that should, I think, demand should pick up slowly. We have seen demand in kind of 5-6% kind of a range. I think if a GDP growth, our expectation is that next year GDP growth can be around 6.3% or so. So looking at the multiplier effect, I think you should see cement volumes pick up slowly. And capacity utilization levels are still pretty low.
Yeah.
So and we don't see any big capacity coming in cement. Again, as you know, gestation for a new plant to come in is now, the time cycles are much longer. So if demand picks up next year, then I think you should see the capacity utilization move up, and that should do pretty well. So even in now in the current environment, also a lot of the companies are still generating decent return on capital employed.
In infrastructure, you're also invested in Max India?
So in infra, we also have some exposure to the financial services sector. Okay, that's part of the mandate. So within that,
a quick comment on the restructuring they announced yesterday, if you can offer one. A broad qualitative comment, if possible.
Sorry, I'm not.
Really, okay. At this point in time, my gosh, so many restrictions on what you can or cannot say. Is it from here on? But some other interesting stocks there, like WAPCO, for instance, in infrastructure, Cummins. What's your outlook on whether you see your fund's done very well? Compared to the benchmark. What do you expect will be, let's say, the fortune of infrastructure through the course of 2015?
So I think infrastructure, if you break it down, there are two. One is the asset owners which are there, okay, which are now currently facing a lot because there's over leverage over there. But there are the equipment suppliers or the industrial companies which are currently going through a downturn because we've seen the overall capex spending is at an all-time low.
Yeah.
But a lot of companies have got strong leadership position or competitive advantage and been able to look at opportunities, not only India but in the export market, a company like Cummins or WAPCO, so which has given them a good balancing when domestic market is not grown. And now with domestic market likely to pick up, I think, and the stronger names, I think in the players who have been market leaders, they should be able to get back the growth much faster over there.
Mahesh, one final question from me with regard to the real estate market. Now, we've seen that from the time we have a new Prime Minister, things are looking good, the equity markets run along, but is that temptation to put some money into real estate stocks?
So real estate sector, we have seen that the stocks haven't really done so well for investors. I think real estate prices have moved up.
That's right.
Normally, real estate sector should do well at the later part of the cycle. Because that's where you will see consumer surplus savings really coming up, and as even the commercial part of the real estate is also pretty subdued.
Right. So when's a good entry point for that?
So I think good entry point, normally you would look at the mid part of the cycle. See, we are at the bottom of the cycle just trying to pick up. So that's where initially you will play some of the consumer discretionary and the financials. And I think at the latter part of the cycle, as interest rate cuts have happened, but we haven't seen any meaningful fall in terms of mortgage rate. So if that happens and as business activity picks up, as job creation happens, I think that should provide better growth for the real estate sector. But at the moment, we have not so too inclined on that space.
I want to talk to you about financials. It's been sort of your biggest overweight, so to speak. Will you continue to stay overweight on financials through the course of the year? Do you think much of the gains have already come in? And I think Nigel was asking in the break about, PSU banks and whether your outlook towards them is likely to change, because right now you're skewed more towards private sector banks.
So financials, we have been pretty overweight for the better part of last calendar year. I think we also launched a fund 1 year back in the banking and financial, because our belief was that at the bottom of the economic cycle and things like to pick up, this is a sector which does well in the initial part of the rally, and it's played out pretty well because it's a broad proxy to the economy. And especially we have seen the private sector banks in India especially, despite the market cycles, have been more compounding stories. They've been able to take market share from PSU banks. So our overweight has always been on private sector banks. More it was in the retail banks, okay. But the last 1 year we have also taken exposure to banks more exposed to the corporate side, because we believe that some of the stress which was in large corporate, I think we've seen some deleveraging over there. I think to a large extent, I think the re-rating on the banking sector has happened. I think no longer the price to book value multiples are as cheap as they were 1 year back. So now I think it will be again banks which are able to really capitalize and grow, okay, their earnings and have a better product mix. I think they would continue to do well.
So in your assessment, which ones would those be?
I think some of the banks, especially on the retail part of this thing, will continue to do well. And also on the corporate side, okay, focus on the small and medium enterprises. Those can do well as the economic cycle recovers.
PSU
and on PSU banks, we've initially were quite underweight. We have corrected that. We are more or less neutral now. I think as the economy picks up, as the NPA cycle has peaked out, and rate cuts, I think there is now greater interest to look at PSU banks. But there again, we are very selective, only at banks where we are comfortable with the leadership, and also banks which are well capitalized, because I think a lot of the PSU banks will still require equity infusion, and that would really weigh down, especially when...
Would SBI be top of the heap for you?
So in our portfolio, SBI is one of our top holdings in the PSU banking space.
And continues to look more promising through the course of the year.
It looks steady. I think more important is to be comfortable in terms of the asset quality and everything. I think and growth will come in, and with cut in interest rates, I think you will see also a lot of the PSU banks have got a bond portfolio where they should make some gains in the next few quarters.
Okay. All right, then Mahesh, let's talk about the IT space, moving away from the financials. I believe that there's not much exposure on that end. What exactly is exposure? Do you think that some of those stocks will do well going ahead as well?
So the IT sector, we've seen last year was a pretty good year, okay, for the IT sector. Going forward, I think looking at the budgets for this year, things looks to be okay. I think probably would be a tad lower in terms of overall dollar revenue growth than what we saw last year. But I think IT sector should do steady. I mean, there's no spectacular surprise negative on the positive side, at least in terms of the dollar growth. I think the cross-currency movement is something which can impact some of these companies which we saw in the last quarter. And I think that's something which might continue in for the next couple of quarters also. But broadly, I think we expect IT sector should be in line. And that's where our exposure to the IT sector is neutral. We aren't too negative on that space.
But I see only Infosys, HCL Tech Mahindra in some of your top 10 holdings, not TCS.
So I think we've been, at various points in time, okay, depending on the valuations and growth, I think we would change our weightage. But I think we would have a fair allocation across some of the larger names. But we have actually played to prefer some of the mid-sized companies, okay, where we believe that the growth, okay, could be better than the industry and where the valuations are reasonable. So I think we always have a spectrum or growth
basically TCS
and valuations.
Lower valued.
So TCS is also one of our decent holdings, but relatively, compared to the benchmark, probably it would be slightly lower.
ITC features prominently in some of your top 10. What's your outlook on that company, if you can talk us through that? And, I'll connect that to the fact that consumer staples is an area that you are underweight in. So I'm sort of leaving out the cigarette business and, looking at some of the other FMCG-related businesses in ITC.
Yeah, so I think in the consumer space, we've seen a lot of stocks where the valuations continue to remain pretty high. We have seen some kind of a slowdown in terms of volume growth if you look at the last quarterly numbers. But I think India consumer will be a long-term secular story. So it is a kind of stocks which normally you wouldn't see much of a correction. If at all, there could be a time correction. So I think selectively on ITCs particularly, I think again stock has underperformed because of the government controls on
the
expectation. And normally going ahead into the budget, okay, we see some kind of other thing, but I think on a valuation framework, I think it still looks
What would you need to
attractive.
see for you to become a little bit more positive, or, you know, sort of adjust your weightage on consumer staples? A better volume number, is it, across the board?
Yeah, I think that's the bottom line over there. I think the volume numbers picking up. You might see this couple of quarters, I think margins could actually be better, and
So
that
it's
could
interesting
rise.
because Adi Ghosh was telling me, he says he saw volumes already picking up in the second half. Of course, this depends on what brands you have, which parts of the market you cater
Yeah,
to,
so whether
etc.
we are more rural
But he said
focused or
rural and urban volumes have been picking up in the second half of this year,
Okay.
and he's seeing visible signs of a pickup already. So, you know, is this the right time to start getting into consumer staples, or you'd wait for a little bit more evidence?
So again, I think volumes, as I mentioned, if consumer confidence coming back, you should see spending, and especially at the higher end of the chain. Okay, we have seen some down trading happening in the consumer in the last 1 or 2 years. So I think that's where I think you could see a better growth. And I think more the urban demand, I think our theme is that rural consumption, I think, would see some kind of a slowdown. Okay, we have seen rural wage inflation at almost 5-year low. We have seen MSP increases have been in single digits. So that was a big driver for rural economy in the last 3-4 years. So that will, so I think urban economy will come back. So I think companies which are positioned more on the urban side, I think there you could see a better volume surprise in the next few quarters.
Okay, we're almost at the end of our time, Mahesh. I want to ask you, you know, about what you think of what the expectations from the budget are. I also want to ask you about this year in investing. How difficult is it going to be vis-a-vis last year? And what some of your best bottom-up picks are, since that's your sort of articulated strategy for 2015?
Yeah, so I think on the budget, I think the budget has to some extent lost its, people give a lot of weightage to the budget, but I think a lot of things the government
is doing
outside that. So I think one should not really, I think budget would be a direction, okay, where the government focus will be in the next few years, and also in terms of fiscal consolidation, okay, how they're trying to really balance fiscal deficit as well as growth. So I think one will look at what the government spending is going to be, because I think that's going to be critical for revival, because I think private sector investment will still take some time.
Yeah.
So that's one thing. But I think the focus, whether what they've been saying, and the budget is really articulate, putting that numbers to some of those things, whether it's in the thrust on the investment side or reviving the whole manufacturing sector. So what are the kind of incentives which are given, okay, for that? That's something which I think one would look out for. And in terms of
investing in 2015?
Yeah, I think this year would be, I think last year was a play where a lot of themes played out. So whether it was the financials or some of the other sectors, and it was more top down, I would say. I think going forward it will be more bottom up, because what I mean is that you'll have to really look at companies where earnings growth, okay, would now be necessary to drive out performance. I think to a large extent the hope and expectation that we've seen re-rating happening without any change in earnings last year. And last year also was a year where a lot of fund managers generated a lot of alpha. If you look at the alpha in last year, on an average would be around 10% or more, compared to an average of around 3-4% over the last 5 years. I think that would be more stock specific. So I think it will be more important to be connected in terms of the companies one is investing into, in terms of where the earnings delta change would be, to really drive out performance. So I think that's what I mean in terms of more of bottom up stock picking.
All right, Mahesh, we'll leave it there. Thank you very much for joining us.